Okay, yeah. So, okay, hi guys. Today we have a pretty exciting Q&A with Dom from A10 Trading. So basically, it's a lot of questions to do with what the experiences of an institutional trader, lah, which is gonna be, in my opinion, very eye-opening for people because especially even myself, right? I don't have any like Dom is my only personal contact that has traded in an institution before, lah. So it's pretty exciting and quite interesting lah to kind of know like what is going on behind the scenes and what like us retail traders, right, can actually learn from people that have actually traded in institutions before lah. Okay, so just a quick introduction. Yeah, so this is our personal like our company Instagrams. So yeah, definitely go and follow A10 on Instagram lah. They have some pretty interesting educational posts also on like market maker strategies and stuff like that. Yeah, and what how a brokerage actually works. So it's pretty interesting, especially for those that are already trading, right? And already like consistently trading. Definitely try to understand and learn a bit more. Like personally, after seeing those posts, I learned a thing or two, like, and after talking to him, like I learned like roughly the idea of like what's a book, ebook, which will be explained later on also. So it should be pretty fun. So yeah, maybe Dom, you wanna tell them more about yourself?
Yeah, okay. Hi everyone. So I'm Dominic. Trading wise, I have about 9 years of trading experience, right? And 4 years in the institutional market. So before trading professionally, I used to be an Air Force personnel, so I was a regular. And then I started trading when I was 19. And when I started trading, right, I had no mentors, nobody to guide me. So I went to follow those courses and books online, right? And true enough, I lost all my money. So all the savings that and all those bounties that I got from signing on, right, I lost it all on the trading market, Forex in particular. So my losses, I think, chalked up to about 70, 80,000 when I was like 20, 21. So at that time, right, I was thinking, why do I keep losing money, right? And no matter what I open, no matter what I buy, no matter what I sell, right, it always goes against me, right? So and then I started to research more into the idea of the counterparty, right? Like what is the what who is on the other side of the trade, and um who is the one going against me, and why do these people keep making money from me, right? At, so through my research, I managed to figure out why um retail traders always lose. So you always hear the term like 95% of all traders always lose, right? And there's a reason why they do. So and partly, right, it's not really their fault also. And today's discussion, right, we'll be talking about why retail traders lose money, and how to avoid these losses, right, and how to think like and to know what the institutional trader is thinking. So I hope my insights today can help you guys to better understand how a market maker works and how a market maker thinks, and it will help you to improve on your trading mentality. Right. Okay. So like I said, 5 years in the retail industry, right, and took me about after losing money for 2 years, took me about 3 years to make my money back, and then I had an opportunity to work in uh Beijing for a while. I worked in China for a while as a dealer. So I was working as a dealer in China brokerage. So what is a dealer? Dealer is essentially the counterparty in the trade. So whenever you submit an order, right, like you buy one lot, when you submit an order, buy one lot, buy two lots of Euro USD, right, you only see in your account, on your MT4 or MT5 account, the numbers going up and down, right? But there's someone at the back controlling your order as well, right? So these people, they are called dealers, right? And we dealers, right, we are essentially people who fight the traders. So whenever what we do is that we want to make money from the trader, right? But there are two types of traders. So people who are profitable and people who are always losing, right? So our aim, right, is to let the profitable traders win from the market, right? And let the losing traders lose the money to the company, right? So this is the idea of how a dealer works, right? And based on how much revenue we generate for the brokerage, right, we'll get a commission. So at the time I was a trainee dealer, I was a amateur dealer, right? Like new to the company, I was taking about 8% commission for trading for the company, right? So the company has a flow of maybe about 50, 60 million, and then how dealers operate is that they will just control one or two pairs, right? So in my time as a dealer, right, I was working purely based on Australian dollar. So all the Australian dollar related pairs are like GBP AUD, Euro AUD, AUD JPY. All these the flow will go through me, and then I'll be controlling whether this particular order I want to hedge the order or I want to keep the order in the brokerage, or I want to push it out to the market and find a matching counterparty, whether and to essentially control the flow of the brokerage, right? So and then you have other dealers. So the entire brokerage they make out maybe three to five dealers, right? And the bigger ones will have maybe 20 to 30 dealers, are all looking at the different markets. So based on this, then you can see that actually the moment you open a trade in the with a brokerage, right, there is already somebody going against you already, and you have to outsmart and outthink them, and to think what they are doing and try to figure out what they want to do with your order, right? So today's discussion will be covering the first part is based on this. Okay, and then I had a couple of other questions, right, that are asking how much money do you need to make, right? How much capital do you need to make money as a main income, i.e. become professional? So we'll be covering all that also. Okay,
so first question, let's start off the Q&A. So these are questions that are sent to our Instagram posts and stuff. So we kind of pick the few best ones and the most the ones that are worth covering. Okay, so I think the first question, personally, I talked to Dom about this before, so I kind of know here and there a bit of what he uses. But maybe Dom, can you share with them like what indicators do institutional traders use, or maybe what you use, if you are okay with sharing? Yeah.
Okay, so this question I have three parts to it. So it depends on what kind of institutional trader you are, right? So on the retail side, on the retail trader, we talk about you are a scalper, you are intraday trader, swing trader, position trader, right? All right. So on the institutional end, right, it works slightly different. So yeah, the basis of being a scalper, intraday trader, swing trader, i.e. your technical basics, right, it applies as a institutional trader as well, right? So we also do use, so the first thing is that these institutional traders, right, number one is they must know what the retail market is doing, right? Because that's the only way you can make money from the retail market, right? So the institutional traders do use your indicators like RSI, stochastic, Fibonacci, all the things, drawing the lines that you have available, that is available to all. So you have a trading view account or MT4, you're able to draw lines, you're able to draw trend lines, draw horizontal lines, use your momentum indicators, your oscillators. So all these apply on the institutional level as well, but we do not use them to trade. We use them to see what the retail trader is doing, and then we'll know from there, like at this particular price point, we'll know this level, okay, 100% confirm a lot of retail buyers will come in and buy, right? So when a retail trader comes in and buy, then we are then on our end, we have to take the order from the retail trader, correct? So whenever a retail trader opens a buy position, we are essentially opening a sell position, all right? So based on this sell position, we must decide, okay, do we want to keep this order? That means, do we want to take the sell order, or do we want to push this order out to the market, to the liquidity provider at the back handling the trade? So based on this, the first thing we will do is that, okay, we'll definitely use your normal indicators that the retail trader uses, but we will not use them for our own trading. We'll use them just to see where the price points are, your demand supply zones are at, and that's all there is from the indicator standpoint. Okay, so now the second part to the order is that, okay, after the order comes in, when we expect this particular price level to have a lot of order flow come in, right? So we are already prepared for these orders to come into us already. All right, so at a particular price level, then we'll know that, okay, at this level, a lot of buy orders, we expect a lot of buy orders come in, right? So the next thing we'll do is that, okay, then the second thing that we have access to is we have access to the order book, right? So on the retail side, you can never see what is going on in the market, right? Because number one, Forex is essentially over the counter, it's OTC. There are many brokerages, there are many liquidity providers. Nobody can really know how much is on the buy side, how much is on the buy side. Even things like your IG sentiment, showing how your clients, how many percentage of clients that are net long, net short, right? All these kind of things, they are only specific to the brokerages. Means your IG sentiment only applies to orders flowing in IG, right? But it doesn't matter to us, because at the end of the day, we are a brokerage, right? So we are essentially then we know, based on all our clients, be it 10,000, 20,000 clients coming into our brokerage, the order flows are coming in, then we'll be able to balance out how many people are long, how many people are short, right? And then we can, from there, we can decide like, okay, if we do not want to take this pair, then we'll push out all the excess long orders or excess short orders out to a liquidity provider, right? So the second thing that we use is this is essentially what you call the client sentiment indicator, but we call it the order book. Okay, so that's the second thing that the institutional trader uses. Okay, and then the third thing that the institutional trader uses, right, is obviously his own device strategy, right? So this one is on a personal level. So personally, I do not believe in like RSI, stochastic, all these kind of short-term indicators. Number one, because they are very momentum specific, right? And they are lagging indicators. So whenever you open a trade based on indicator, you are already late, right? So like I said, RSI turns bullish, right? But actually the price already moved up the maybe 3 to 5 candles ago. Then only on the fourth or fifth candle that you start to see the bullishness come in. So when you come into the trade, then you are already late, right? So for personal trading, on a personal trading level, right, I only use price, right, as an indicator. So I only look at the candlesticks, purely based on the candlesticks. And for stocks wise, I use volume, because volume is another important indicator. So you need to know why volume is important, is because you need to know whether it's money coming in or coming into the market or money going out of the market, right? So if some big player comes in and opens a long position, right, and then the price moves up, then you know that he's entering the market and the price likely will continue to move up, right? But if there is money exiting the market, i.e., right, the price moves up because a big player exits his short position, so it's money flowing out of the market, right? So on both cases you see price moving upwards, right? But one is somebody entering a long position, the other one is somebody exiting a short position. So volume is quite an important indicator as well. Okay, so these are the two that I use. Those that are interested, you can try this indicator called visible range, right? So it's called VPVR, visible range on TradingView. This one, yeah. So this is what, yeah, this is,
yeah.
Sorry.
No, I actually started implementing that also. VPVR. Yeah, 666.
Yeah, so VPR. So this one is it's good because VPVR measures the price tick volume. It's not exactly how much money is flowing in and out of the market, but it's how at that particular price level, how many times the price change, right? So how many times the price tick. That's why it's called price tick volume. So tick is like it go up down 0.1, 0.2 pips, up down, right? So how many times it fluctuate at that price level. Okay, that is called the visible range. So it's a good indicator because at that level, if the price fluctuates a lot, then you know there's a lot of money changing hands, right? So then there's a lot of volume at that level, right? So typically, when places of high volume will be places of demand zone and supply zone, right? And it's more accurate than your normal volume indicator, is because, like I said, forex, right, mostly trading is all OTC. It's all over the counter. There's no centralized exchange. It's very decentralized and very broker specific. So the only thing that is reliable is how many times the price change, because no matter what, across all brokers, the price is always the same, right? So the price, if the price for EURUSD is like 1.2040, you can see across all brokerages, it's all around that. Maximum there'll be a difference, maybe 0.1, 0.2 pips, because the market is very efficient, right? So how many times the price change at that level, right, is a better indicator of volume than your normal volume, right? Yeah. So to reiterate, I use two indicators myself. One is price tick volume, the other one is just the price itself. And then for the market makers, they use the order book on retail sentiment, and of course to find out what the retail traders are doing, then we will use our retail indicators to plot and figure out what they'll be doing at a certain price level.
Nice. I mean, VPVR is something I started using personally also, I think for 1 month plus, trying to experiment, and I honestly it works. I use it as to layer on with the price action, market structure, and basically the whole strategy. I just layer it on for final confluence. Yeah, which I feel is it works lah. So I mean, for those of you guys in this call, if you all want to try it out, yeah, it's called VPVR. You all can edit on your trading view and stuff. So yeah, anyways, I think let's move on. Dom, you got anything else to cover for this this question, or can move on to the next one? Okay. Wait. Hold on.
Yeah, sorry, I went to mute myself and I couldn't unmute because of the co-host.
Yeah. No, I made you host already. Okay. So okay,
Okay.
anyway, Dom, you got anything else to cover for this topic, or we move on to the next one?
For this question, no, like I said, it's just the three parts of the order.
All right, can. So okay,
Okay, yeah, we can move on to the next one.
yeah, this one is going to be pretty interesting. Okay, personally, when I first met Dom, I had no idea about what this is stuff, and I think it's worth knowing also for those who are already actively trading, right? And then and really want to understand what goes behind in a broker. Yeah. Okay, so Dom, you want to share with them what's B book, A book, B book lah.
Yeah, so this question, right, actually, this question is quite an advanced question. Because a normal retail trader wouldn't think so far into this question. So this particular question actually came from one of my students. And the idea behind B book is very simple, right? So I will think of this idea. I will explain this idea in the form of like a casino, right, or as a or like Singapore pools, right? So whenever you take a bet, right? So let's say if you are in a casino and someone bets, let's say baccarat, he bets on player, right? So the casino is forced to take the bet, right? So at the end of the day, no matter what order flows through the brokerage, right, they are all B book first. Right. The moment the order flows through the brokerage, the broker immediately must take the counter becomes the counterparty of the trade. So let's say if you long Euro USD, I mentioned in the previous question, right? The broker will be short on Euro USD. If you long one lot, he'll be short on one lot, right? So the idea between A book and B book is very simple, right? B book means, right, the broker takes your order. So i.e. the broker becomes the casino. So if you win from them. If you lose to them, right? And then the opposite of B book is what we call A book. So like I said, the dealer will try to balance and try to push orders that are winning into the market and try to keep orders that are losing internally to the brokerage. So, but it's very difficult, right? Because I mean, dealers can fail also. Sometimes they are just wrong about the price action. Then if you do a hedging trade on, if you hedge an order that is clearly winning, right? Then you end up losing, not winning money for the brokerage, right? Or if you were to B book and find an order that is clearly winning, then you end up losing money for the brokerage. So this one is a very tough process, and it's not simple to be a dealer. So ideally, what happens, right, is that we do not the broker usually does not B book based on the price action on the pair. Rather, they will B book on the account. Right. So if let's say like I mentioned, 95% of all traders lose money in the markets, right? So out of 100 traders, 95 traders will definitely lose, right? Because they of their own strategies, or they like to martingale, right? Like buy the dip and then at a certain level they just margin call and their account wipe, right? So based on this, right, even if a broker operates on a full B book model, right, they will still make money, right? Because out of 100 people, 95 people will win money. The five people that are winning money, right, will be easily covered by the 95 that are losing money. So most brokerages, right, they will operate on a B book model. That means your order will never actually go out to the market. So that's why you can have somebody buying 200, 300 lots, right, and then the price can still execute at a specific price level. You know, like 100 lots, right, is essentially 100 is 10 million, right? So if you buy 10 million of a currency, right, by right, the currency should move, right? But it doesn't move because sometimes the broker just takes your order, right? Just B book your order, right? And then they keep it internal to the brokerage. So this is what you call B book, right? So it's dangerous. The dangerous thing about B book is because you do not know what type of account you are, right? So you don't know whether the broker puts you on A book or puts you on B book, right? So if he puts you on A book, then it's very clear cut. Your order flows in, straight away it goes out to the liquidity providers, right? Then you know there's no manipulation on your side, right? So the broker will not like start to increase spreads and start to stop you out prematurely, right? So as a dealer, right, this is something that we are taught to do. You know, a dealer, in our dealer lessons, right? Then the company will tell us, say, okay, you see, when you see an order, when you see a particular order going to hit the stop loss already, right, you will widen the spread and cause them to hit their stop loss to make money for the brokerage. And this one applies if the client is on B book, right? So the only way to escape the B book, right? Most of the brokers, they have this 100% model, right? So if let's say you put a deposit of $10,000, right? Usually for the first first deposit, right? So they have a threshold of like maybe 10,000 or 15,000 or 20,000. Every broker is different, right? Some can be as low as 2,000, right? So what they'll do is that they have a threshold that they'll allow you to win, right? So it's either 100% of your initial deposit. So let's say if you fund in $4,000, if you make $4,000 from them, then they'll automatically switch you to A book already. right? And then you don't have to worry anymore. So you make 100% or more, right? Or the second one is that you deposit big enough that they are scared to B-book you.
Yeah.
Meaning that if you put in 200,000, right, and then they realize, okay, if I have to B-book you 200,000, then it's very difficult, because if you win 200,000, then the brokerage lose quite a bit of money, right? But 200,000 is nothing to a brokerage, right? So at the end of the day, right, the idea is very simple. So you want to avoid the B-book, but you do not know what the broker is doing. Any broker that tells you, right, oh, we do not operate on B-book, we push all our orders out to the liquidity provider, it's all crap, man. All brokers, right, they operate on a hybrid model maximum, meaning that they have A book and B book, just decide which to put you on. Right, so there's no true brokerage, right, that does full A book one, especially on CFD trading, which is forex trading, or forex trading in essentially that. So most of the orders that come in, right, they're all B book one. So there are telltale signs of what you can, or there are telltale signs to see whether your order is B book. Number one, okay, if you hit a big lot size, usually anything more than 20 lots, right, if you are trading lot, right, if your order fails immediately, meaning you set a buy limit order and the price falls, hits your buy limit order, right, and straight away all 20 lots get executed at one shot, then you can, okay, likely you're on B book, right? So the 50 lots, 100 lots, definitely you're on B book. Because why? As a liquidity provider, right, okay, so on the liquidity provider end, there's not just not enough flow to one shot execute 50 lots for you at one specific price. What what will happen is they will do this thing called partial fill. So when you execute 50 lots, right, some brokerages you can see it when you open, like maybe open 5 lots, 10 lots, right, then you see your order suddenly split up into 3, 4 different orders, right? Like you put in a 10 lot order, then you get like 2 lot, 3 lot, right? So you have multiple orders coming out. Then when you only enter one 10 lot order, but you end up having four orders on your MT4, right, then you know, okay, for sure this one is on A book. Why? Because of the partial filling thing. Okay, so one way to tell to know whether you're on A book is about if you have a big lot size and you get immediate fill on your order, then you know for sure you're on B book. If you get partial fill, multiple fills, then you're on A book. So that is one way to do it, right? So the second way to do it is slippage. So technically, right, if you are buying up the market, if you long, you market buy at something, right, by right there should be a slippage factor, right? So if you buy, then you slip by maybe 0.5 to 1 pip, right? But this one is not so good. It's because nowadays, right, the brokers are very smart. They know that people can tell if there's no slippage means they're on B book. So what the broker will do is that they will still take the order. They'll take the order book from the liquidity provider, get the price quote, right, and then they'll still do the slippage on you. So essentially, you want to avoid being on the B book. You want to be on the A book. So one way for sure to be on the A book, right, is that you make 100% on your account or more. Definitely you'll be on the A book already. Right. So why B book is dangerous is because anytime, like I mentioned, the broker can increase your spread to spike you out and to stop you out of the position. They will never do that for A book position. Why? Because it doesn't make sense, because they are not making the money when the client loses. They will make more money if the client makes more money. Why? Because if you are making money on a brokerage, you're opening more trades, you are generating more commission for them on the A book. So that's why B book is dangerous, because they will stop. If you make if they are B book operated brokerage, right, then they'll start to play with your orders, right. Then when the market open at like 6 a.m., 5 a.m., 6 a.m., right, you start to see the spread suddenly increase, and then for no reason your order just get taken out, and then the spike and then the spread suddenly reduce again, right? Or during NFP, FOMC, those kind of high market moving news, right? When the market start to swing, you'll start to see the price swing, right? The spread increase, right? But actually all this, right, is might be just the brokerage doing this, not the liquidity provider side. And the worst part about this is that you'll never know, right? Because you don't know you don't know what's going on. They can write any cock and bull story to you and say, oh, no liquidity, higher spread, and this is the price that the LP quote last, but you'll never know, right? So that's the idea of B-book, and why it's dangerous if you don't know, if you are amateur trader, right, and most of people lose money. I said 95% of people lose money in the markets, right. Maybe only 60 to 70% is their own fault. 30% is because the brokerages are targeting these kind of people. So the more amateur traders come into the market, right, the more these brokerages will make money, right. So this B-book model is a very profitable industry. Yeah, so that's for this question.
Okay, next question we have is why does price keep falling when the client sentiment increases in long percentage? Shouldn't the price go up if everyone is buying? Yeah.
Yeah, so this question actually is quite funny, right? So
Yeah.
based on market fundamentals, if you think if everybody is buying, shouldn't the price should increase, right? Correct. So um this one is actually quite interesting because like I said, the difference between a normal market, right, and in your trading market is the equity market versus the contract for difference market, right? So equity market is when you buy you physically buy the product, right? Like you buy a PS4, buy a PS, buy a PS4, buy a PS5, or when you buy a product, you actually receive the product and you're expected to pay the full sum for a product, right? So i.e. on a stock market, let's say if you buy 100 Apple shares, right? You get a share certificate owning 100 Apple shares, you are expected to pay the full price for the Apple share, right? So this is called the equity market, where the money actually changes hands. When the product actually changes hands, meaning it transferred from the previous owner or the brokerage to you. This is the equity market. So if the price keeps going up when everyone is buying, right, this only applies in the equity market. It doesn't apply in the contract for difference market, right? Because CFD essentially is just contract. Everything is on paper, right? So like you long gold, like let's say, okay, so gold is a good example. Let's say when you long gold, right, on your MT4 account, you're not actually buying the physical gold and getting it delivered to your house, correct? So it opposed to going to the jewelry shop and buying the physical product of the gold, right? So if there is no supply of gold, then the price of gold will go up, if everyone is buying, right? So this idea of shouldn't the price go up if everyone is buying, right, is only based in the equity market, what we call the traditional market, right? So the CFD market, okay, back to the idea on going long on gold on MT4. So when you buy one lot of gold, right, you are buying 100 ounces of gold, right? But you are trading on margin, right? And your order is filled. When you buy gold, your order is filled, right? Usually, the brokerage, right, that is handling your order does not have the gold one. They do not have actually have the physical stock of gold to say, okay, you want to buy gold, I deliver the gold to you. No, you're actually trading a contract, a paper, right? So immediately there will be a counterparty at the other side who is short, right, to balance out the order, right? So if somebody is long, there must be somebody who is short. It's a zero sum game, right? Because there is no physical product being delivered, right? It's just a contract being open. So why does the price keep falling when the client sentiment increases in long percentage, right? So like I said, if everybody is long on the market, on the gold market, right? Let's say 80% of the people, 70% of the people is long on the gold market, right? Suddenly from 40% become 50%, become 60%, 70%, 80%, right? So the more retail comes in and buy, right, it means that the counterparty is more short, right? So if 80% of people are long, it means 80%, the market maker is short 80%, right? So when the market maker is short 80%, right, do you think he will let the price go up? No, right? Logically speaking, if the price go up, the retail make money, right? So that is the idea of why when the price they'll keep pushing the price down, right? To try to make you get out of the long position, try to make you realize the loss, right? And then you realize that sometimes when you buy, right, then you hit your stop loss and then suddenly the price shoot up, right? So there's a reason to why this happens, because they can do this thing called short laddering, right? So they'll just create like fake orders, right? They sell to each other, like A sell to B, B sell back to A, and then keep selling and moving the price down, right? And then when the price moves down, the retail will say, hey, buy on dip, right? So like start the average down, start the martingale, and that's why the price keeps falling when the client sentiment increases in a percentage, right? So my strategy to you is very simple. So if you see a client sentiment starts to increase in long, right, and you're in a long position, right, instead of adding a long position, maybe what you can consider is, just get out and open a short, right? So be on the side of the market makers. That's what I can say for this.
So I think next one is pretty interesting. I have also have my own inputs on this lah, because the rest is more about institutional trading, which obviously I personally don't. Okay, but next one is how much money should I have to become a professional trader? But yeah, I think we have our own views on this lah. But maybe Dom, you can share your views first.
Okay, so I think the first we need to define what a professional trader is, right? So a professional trader, I would think that is someone who trades full time, right? So he has no other income sources, meaning he does not have other jobs, meaning i.e. it's not a hobby, right? So you do not just trade for a hobby, you don't trade to make a side income. Yeah, trading, that is your main income, meaning that if you do not make money, you got no food to eat, you got nowhere to stay, right? So then it creates a lot of pressure on you, right? So as a professional trader myself, right, like I really make money from trading, and that's my main rice bowl, right? So being a professional trader, the difficulty lies in creating the consistent income every month, right? So every month you have a target, you have your expenses, you have to pay your car loan, your house loan, and then there must be a set amount of money that you must make every month, right? So realistically, right, it's just not possible to make 100% every month. All right. So based on the fact everybody can make, if you can make 100% every month, can make 50% every month, then why then you'll be Warren Buffett by the time you're like in like 5 years, right? Or you'll be like richest person in the world if you can compound your account 50% every month for 5 years, right? So it's just not possible lah. So the idea of being a professional trader is that you do not have any side income, then the risk factor becomes very big on you. So you cannot be like people who trade as a side income and they can risk 5%, 3%, 2 to 3% of their account in one trade and be fine with it. Why? Because they have income from other sources, right? So as a professional trader, right, the amount to trade as professional is not small. Minimally, I think you'll need like 6 figures, like about 100K. 100K, a good target for a professional trader is maybe about 3 to 5% a month. And then with 100K, they'll probably make like maybe 4 or 5K a month. So that is quite achievable as a professional trader. No, I'm not saying that it's not impossible, right? So I've seen people who like with $10,000 make it to like 100,000, 200,000, 300,000, right? But those are people who can afford to lose the $10,000. Versus a professional trader, he cannot afford to lose his capital, right? So the mentality there is very different already. Okay, so if they say professional trader, meaning making money every month, I'll say you need a good 6 figures to be able to make income consistently and trade for a living.
Dom, I think I want to ask you one thing. Okay, let's say for your views on a professional trader, right? What's the risk percentage per trade that you are willing to take?
Okay, so professional traders, they play the long game, right? So at the end of the day, most professional traders, right, they risk anywhere between 0.1 to 0.2% of their account per trade only. So if like if on a $100,000 account, right, you'll never see a professional trader risk more than $200-300 a trade. It's a grind, like it's really a grind. So you want it's the idea of EV, right? So you want to, your win rate is like 60%. You'll win 6 out of 10 trades. But you cannot afford to lose 10 trades in a row, right? So that's why but you must be able to afford to lose 100 trades in a row and still be able to let your EV play out lah. So I had a situation where I lost like 23 or 24 trades in a row, and then this happened like maybe two years back, and then it only eat into 3% of my account, 4% of my account, right? So this is the idea that you want to it's a long game. Like I say, it's a big numbers game as a professional trader. So obviously a professional trader will risk way less than a normal retail trader who's just making a side income, right? So typically you'll see people who are in forex trading risking 1 to 2%, 3%, some even 5%, right? But a professional trader will never risk anything more than 0.5% of capital. And even 0.5% right, is because the reason why they risk 0.5% is because they really have a very, very strong case, right? And it's not like they martingale, right? It's they're using profit and try to make more money. So at the end of the day, you can see a very, very big difference between the amount that a professional trader risks and the percentage that a professional trader risks and the retail trader risks. But it's partly due to the account size also. So let's say a normal retail trader got $10,000 in an account, risking $100, right? Risking $200, right? He's risking 1 to 2%. But the professional trader, right, he has 100,000 in his account. He's risking 100 to 200. Essentially, he's risking 0.1 to 0.2%, right? So the amount that both parties risk, right, is the same. Both are risking 100 to 200, right? But one percentage wise, one is way lesser than the other because the professional trader requires this as an income. He must make this money every month. He cannot afford to lose the capital, right? But a retail trader can afford to lose capital because that's not where the money, his main income is coming from. Yeah.
Okay. Personally, what I feel for professional or full-time more full-time trader Okay, I feel is that because personally I stick to 1%, 1% in risk. Um, previously it was 2, but cut down. Okay, with
Yeah,
1%,
so there's a reason why you cut down also, right?
yeah, there
Right,
is,
because you understand the mathematics and logic, and you cut down from 2%. Like maybe last time you're at 5%, then you cut down 2%, then you cut down 1%. And why you cut down is because you realize that your capital is growing, right? You have more money, and then you realize that actually I don't need to risk 2 to 5%, right? I can risk 1% and get the same results and get the same amount of money every month. So
yeah,
so you're going down the professional route already.
mentally it's a lot easier also lah. I mean, it's easier to manage everything also.
Correct. Right. So
Yeah,
yeah, so when you have 100,000, then when you got 1 million, when you got 10 million, then you
yeah,
realize that actually I don't need to risk so much, right?
true.
And then so it gets easier, right? So when you're a professional trader, it gets easier. Definitely gets easier when you have more capital, right? So the difficult part is building the capital up, right? The capital gains part. So you have to build 10,000 to 100,000, 100,000 to 1 million by slow compounding, right? And
Yeah,
then only after you hit a certain level, then you can start to become a professional trader,
yeah.
right?
I feel, yeah,
So
really,
yeah,
really,
so
uh,
that's why
yeah,
you're seeing your risk appetite drop from 2% to
yeah,
1%, right? And it's a good thing. Why? Because it also means that because you are making more money, right? And your capital is growing, that's why you can afford to risk less and get the same results.
yeah.
So you're actually doing what most professional traders are doing already. So it's a good thing.
Yeah, okay, my opinion, like from like let's say if you risk, okay, let's say if you decide to you trade for like maybe a year lah, I'd say maybe a year or two, you really want to do it full time. In my opinion, a full time pay for a Singaporean that should be there to like really just sustain and survive should be about 3K, 4K.
Oh, 3K. I mean that's 3K is
Yeah,
possible. I mean 3K is an average
yeah,
income, right?
income, but
So
really basic.
so the idea is simple. Yeah, it's really basic. So if you want to make 3K a month, it's achievable, right? And big capital is achievable also. But the thing is, you need to ask yourself what's the opportunity cost.
Yeah,
Because if you are going down this path as a professional trader, right, and you are grinding out 3K a month, versus if you were to work for a bank, example, like, or work or in some other industry, and you can pull 8 9K a month,
yeah,
then you shouldn't be doing professional trading full time. You get what I mean? So it's an opportunity, it's a time factor thing, right?
yeah,
So the reason why not many people are professional traders, right? It's because of it's the opportunity costing, right? You can trade and make money on the side, and at the same time, you can also do some other job and get paid for it. So it's like a double income thing. So
yeah,
that's why there are very few people who are actually professional traders.
yeah,
Compared, and most people are just your everyday day traders, right? They trade for a side income rather than trade for a living.
yeah, for sure.
Yeah.
I mean, that's the
Yeah,
majority.
because you need to know that trading is not 100 full time also, ma. Yeah,
Yeah,
you don't need to spend 8 hours staring at the chart, right? You can
exactly.
spend 2 to 3 hours a day and get the same results.
I think 2 to 3 is very realistic, right? Honestly, like a day, or maybe like one to two lah. Because
Yeah, but
yeah, really don't need to spend
correct. So
a lot.
you can spend 2 to 3 hours a day and still work another job, ma. So that's what I'm getting at. So
True, true.
that's why the reason that there are very few professionals because of this.
Yeah. Okay. I say one reason, like for
Yeah.
me personally, like since I started out, like one reason I started to like cut my other income sources, like before Emporia lah, like really then after slowly getting profitable, I slowly cut down. Is because the amount that is making from trading, right, is already like what I make in 1 week, right, can be made in one trade, that kind of thing, or like maybe 1 month can be made in one trade.
Correct.
There's no, okay, once you reach that
Correct,
level,
correct. That is because you have capital.
yes,
Yeah,
yes.
that's because you have capital.
So that's one thing. Okay, personally, for in terms of returns wise, monthly returns percentage wise lah, what I feel is achievable, and I feel really, if you're profitable already, that's the thing. With a 1% risk, I feel that growing by about 10, 15, right, is there's no issue with that, in my opinion. Like even 20%, I think that's really, I would even go to the extent to say that it's even easy lah, in my opinion. Yeah, because the thing is, if let's say the
Correct.
R is there, yeah, I mean, there's honestly no issues, because let's say if you have a 1 to 5 RR, right, you take 10 trades, right, 5 win, 5 lose, right, you're up 25% already. Yeah, is it 20%? Sorry.
Correct. Percentage wise, like I said, percentage wise is doable, right? It's definitely realistic. I have months where I do 20 to 30%, but you need to know it's 20 to 30% of what, right?
Yes.
So I have accounts which are 100K, make 20 to 30% a month is okay, right? But when you look at a $10 million account,
Yeah.
do you think and one trade you risk 100K, right? I tell your boss will shrink one.
Yeah.
Yeah, so it's realistic. It's realistic because at the end of the day, you still have to look at the absolute amount, right? It's very difficult to look at the percentage value, right? So when you say 15 to 20% a month, 25-30% 1 month, I would say yeah, it's doable lah. I mean, it's doable on 100K, it's doable on 200K, but try doing it on 5 million, right? Then you realize that actually it's not so simple. There's a lot of pressure going on you, especially when the money is not yours, right? Yeah, professional trader managing money for people, right? And then people start to see their account swing down 10-15%, right?
Yeah.
Because you can make 15% a month, you can also lose 15% a month, right? Basically speaking, right? So there are a lot of factors coming in to pressure you already.
Yeah.
So the best way is, I mean, the most no stress factor is if everything is your own money, managing just your own money, right? Then you risk 1% a month, nobody will care, right? And then yeah, it's very achievable because the difficult thing, right, is the trading psychology and the mentality that allows you to risk 1% a trade every trade, right? 1% on 10,000. 1% on 100,000 is way easier than 1% on 10 million, on 20 million. And that is why you don't see hedge funds, right? You don't see big market makers are making 15% a month, 20% a month compared to the retail traders. It's because of the sheer amount of money and also the sheer amount of volume in the market, right? So when you open one lot, the market, so to make one lot to make 20% on your account, maybe you're opening one lot on a $10,000 account, right? But versus on a $1 million account, you have to open 1,000 lots. So you start to see the issue of the B-book and the feeding thing, right? So when a market maker sees 1,000 lot come in, right, they say, well, this one free money, then they start to push the price.
Yeah.
So there's also a limit to how much you can make, also based on the fact that the brokerages and the order book and the order feeding thing.
Yeah.
You get what I mean?
Yeah.
Yeah, so there's a scalability issue. It's a scalability issue lah. So essentially, I would think that there's a cap to how much you can grow the account 20% a month until the account gets too big, and then you need to know that based on the data, the market makers, there are probably 20,000 lots, 30,000 lots long. If you're hitting 1,000 lots, you're essentially 3% of the world, the entire market.
Yeah.
Then it doesn't make sense already, right? Then they start to see big things happening. Then when you open the position, right, the market will start to move, and when it move, it will move against you.
For sure.
Yeah, so that's one thing that on the back from a brokerage standpoint, I can tell you that yeah, I've seen traders to grow their account 1,000% in 1 year, right, or 1,000% in like 6 months, but they're compounding maybe $10,000.
Yeah.
Versus it's not possible to do on $1 million. Right?
10,000, you can risk the whole thing, and like let's say if someone with capital losing 10K, there's no issue with that also. You full margin 10K, maybe you
Right,
down.
but if you lose 1 million, then it's a different issue. Let's say it's a very mental thing.
Yeah, okay. In my opinion, okay, this question I'd say a fixed answer for me, right? Personally, I'll say average percentage gain, because I think I haven't give you an amount yet. It would be about risk 1%, get 10%. Really average lah. Like really not asking for much kind of thing. I feel that about 30K. So at 30K, maybe like 25K USD lah. About there, then you make 10%. I think that's in my opinion, that's a good start point. However, right, one thing is that for traders that are looking to do this full time, like any of you that are watching live, are thinking of doing full time or anything, anytime sooner. My opinion, my advice is that don't give up your other incomes first, unless this trading thing it really pulls off. Like I'd say maybe a solid like almost 1 year of profiting, like really consistent every month compound like mad, right? Then I say suggest lah. If not, don't give up your other incomes first, because especially like if let's say you're already profiting like for a few months, it looks good, everything, you want to start full time, I say it's a very, very risky thing to do, because in trading, nothing is guaranteed. You profit this month, can lose the next month. Like you profit today, tomorrow also might lose. Yeah, which is the stress factor is very big lah. I mean, which honestly, personally, right, one of the reasons why I started venturing out into like Emporia and starting like programs and everything also, which I feel Dom, you also like have other ventures and stuff, is because those are risk-free incomes and risk-free income streams, which is adding on top of your trading lah, in my opinion. So I say that would be the ideal plan for you guys, especially for those who are looking to trade full time lah. Yeah, Dom, you got anything else to add for this topic?
Yeah, so actually I agree with the external source of income thing, because it takes a lot of pressure away from trading. Right?
Yeah.
And trading, the most important thing is not to succumb to the pressure, right? It's like I said, the mental portion of the trading and the psychology portion of the trading. So having a second source of income, and that's also the reason why a lot of people decide to become trading as a hobby, trading as a side income versus a full-time income. Because once you become like this term, I say professional trader means you trade full-time, right? Then everything is banked on the fact that whether you make money from markets or not.
Yeah.
And that's not a good thing, because if not everybody can handle this kind of pressure. Right?
So the trade is scared already.
Yeah, correct. So you haven't even entered the trade, right? You're already fighting with the mental pressure already. You haven't fight the market, you fight yourself first. Right.
Yeah.
So that's also the reason why I see a lot of people who are actually professional traders, they venture into teaching and education, those kind of things. Right. So it's also to take away the pressure from trading. So I myself, what I do is I'm not big on education, so I do it when I have the free time. Right. But what I do, my side, I call it side hustle. Right. So I do other things like marketing stuff, right? Digital marketing, those kind of things. So these are all on the side, and that takes a lot of pressure away from the trading. Because at least if you lose money in trading, you blow a portion of capital in that month, right? You know that you're covered from the other income sources.
Yeah, for sure. In my opinion, like almost every profitable trader that I know, in terms of I'd say almost every all of them have external income source. Like trading isn't the only one.
Right, and
I actually
correct, and it's because of the pressure.
Yeah, along the way you'll be desperate enough to kind of build it and build another income source. Like for me personally, it was a bit different. Like if you all want to know, like I started out a lot of my trading capital was because last time I was doing like freelance personal trading. The money was fucking good honestly. Like it was like can reach close to 5 figures 1 month, but almost work every single day that kind of thing. Yeah. So but the thing is that a lot of my capital was from there. That's the first thing. And the thing is that when I was already consistently being profitable and already making money consistently from trading, right, I still didn't give up that income stream yet until it's really like, okay, fucking lazy to train people already, right? After that, just fuck it lah, full-time trade. After that, shortly after then, it got better. Then I felt like the need to implement something else like Emporia and stuff. So that was how it started lah. So I feel that a lot of can say full-time traders that rely on trading itself first will definitely venture into something else. It's something that I see among every profitable trader that I personally know lah. Yeah. So yeah, I think that's
and it's more of a, like I said, it's more of a pressure, more of a relieving the pressure factor than the money itself lah.
Yeah, for sure.
Okay, so what we have for the next question?
Okay. Really interesting question. Okay, so do Forex courses teach you what the institutional traders are doing?
Does Emporia teach? Does Emporia teach the stuff that I talked to you about?
For the institutional ones?
Yeah, those based on our discussions, based on my discussions with you on a personal level and in this chat. So honestly, does Emporia teach this?
Honestly, not really in depth because we use a lot of price action market structure. Yeah, and one thing that
right. So
I personally I've slowly only implementing volume lah. It's really not. And I personally what I feel is that any strategy if it profits long, like that's it lah. Yeah, so we personally don't include that into the program. Yeah.
Okay, so the difference between the reason why Forex courses cannot teach what the institutional traders are doing is because most of the Forex courses, right, they are catered to people without the same capital as an institutional trader, right? So when it's big money versus small money, so those strategies that can work for small money, like your price action strategies, right, they can work very well when you have a capital. Your capital is not much, right? It's like under a mil, maybe under 1 million, right? I would say most of the retail strategies can still work, right? So only when the capital starts going to 7 figures, 8 figures, right, then that is when all this price action, all that will fail. Why? Because the moment you enter a trade, you're moving the market, right? So essentially, you become a market mover on your own. And once you become a market mover on your own, right, then it becomes a liquidity issue. You cannot get out of your trade. You get what I mean? So when you enter a trade, the market move. When you exit a trade, the market move against you. So then you end up being split on both sides, and your 1 to 2 risk to reward will essentially become like a 1 to 1.5 risk to reward factor. So the reason why forex also don't teach what institutional traders are doing because there's no requirement, right? So institutional traders, when we hit an order, when we enter a trade, we do this thing called laddering. So we do not enter all our orders at one price level, and we do not. There's no such thing as sniping, right? So like I think a lot of people that this term called sniping the order, like hit and wick down, hit the price and fail, and then move up to the take profit, right? So in institutional level, it's impossible to do sniping because of the partial fill thing, like I said, right? So as an institutional trader, right, the brokerages will never be B1. It's always on A book because they cannot afford to fight this kind of volume. So they'll never have an issue where you can snipe the order, right? And the reason why retail order you can snipe an entry position is because a market maker is moving the market for you, right? So at the end of the day, when you want, let's say you enter one lot and you manage to get down to the exact wick or maybe 1-2 pips within the wick and the order moves upwards, right? It's because the institutional traders, right, are using all your limit orders, right, to help to push the market up, right? So this question, obviously, forex courses will never teach what the institutions are doing, because if everybody knew what the institutions are doing, right, then it's difficult for institutions to make money, right? But I think a general idea of what can be found online for free is I would think commitment of traders data, COT data can be found for free online. It shows you the market makers shows the market makers their positions, but those data is all lagging on. So they report on Tuesday, but you can only see on Saturday, and then it takes a long time for this data to unfold. So it's more catered towards swing traders and position traders, right? And then there's this thing that I said, the market makers also use the retail sentiment a lot. So you can use the IG client sentiment as an indicator to know the price action. So if it's a bullish price action, right, the retail short positions will always increase on, because people will always, because 95% of traders will always martingale and add to their short positions when the price moves upwards, right? Or when you're shorting on a price action that's moving downwards, then you'll see the retail net long will increase. So these two things that I'm sure Emporia will have covered on these two. Yeah.
So yeah, I mean yeah,
Anything to add?
I don't think any. Okay, maybe you can tell them what you cover in your A10 mentorship. I think that's one thing to really include.
Okay, so for the A10 mentorship, right, what essentially what I have told you about how the order book, the order flow, price manipulation, and yeah, it's more of price manipulation, because like I said, the institutions, I know how an institution works because I worked for an institution before, and we do our orders based on layering. So based on how the institutions layer their orders, right, and how the institution collect their liquidity, and then I teach my students how to spot what the market maker is doing, and then you join in when the market maker strikes. So it's very simple. It's just on price manipulation. And not really price action, but rather it's price manipulation trading.
Yeah. Okay, nice.
So those are strategies that I teach. And there's no indicator involved. It's just candlesticks. So looking at the candlestick and looking at a chart pattern, you'll then my students will be able to tell you what the market maker is doing, what phase the market cycle is in, where it's going next, and where you'll go to. Yeah. So I train a lot of swing. I train more swing traders actually.
You guys implement a Wyckoff?
What?
Yes, Wyckoff. The Wyckoff strategy.
No. No.
Okay. What are your
Yeah,
thoughts?
we don't do that. Yeah.
I thought
what I'm
yeah, I thought a lot of traders from institutions do that. I thought I mean, I also don't really know. Yeah, but maybe
yeah, the institutional traders do that, but the institutional traders do that, but the retail trader cannot do that.
I see.
You get what I mean? Because they can. Why the institutional trader can do it is because they can see what the market is doing, but the retail trader, you cannot see what the market is doing. So that strategy doesn't really doesn't really go into full blown scale. You can't really milk that strategy if you can't see the order book, right?
Yep, I see. Got it. Okay.
Yeah. Okay. We can cover the Wyckoff after we finish the questions, so I can talk more about that.
Okay, I think wait let me just see. Is this last? Okay, so I think we've come to the end of the whole Q&A today. I mean, I'd say it's the best one yet lah. Honestly, like it's the most interesting one. For you guys that are in the call currently, you guys have any questions that you want to ask Dom or myself? I'd say more of Dom lah. Yeah, don't need to ask me anything. So yeah, y'all can type in the chat. And I say really take advantage of this opportunity and I really ask him.
Okay, maybe we talk about, yeah. So while they are asking about their question, maybe talk a bit about Wyckoff first. So yes, okay. So A10, um, we cover Wyckoff, right? So Wyckoff is essentially your accumulation distribution model, right? So this Wyckoff strategy is very powerful because it's what the institutions are doing, right? And they can do this. The institution can do a Wyckoff strategy is because they will know the price point and they will know the demand supply zones and they will know how much order is in the market waiting at that price level. So the entire market functions on like limit orders and stop orders, right? So the market maker will know where to take the price to where they can do the accumulation or take the price to where they can do the distribution. So on a retail perspective, right, you cannot use the Wyckoff strategy, right, because you don't know whether a price level will become a demand zone. Sometimes the demand zone can just break through, correct? Or supply zone can just break through also. So the strategy, this Wyckoff strategy, this accumulation distribution model, right, only works if you are a market maker, right? But you as a retail trader, right, you will not be able to predict the accumulation and distribution zones. You can only see it after it happened. You get what I mean? So you only know the price is in an accumulation phase after it starts to range for a while, correct? You get what I mean? So you cannot tell whether it's in the when the price is moving upwards, you won't know when it will start distributing, correct? You only know it goes in a distribution phase after it starts to do your up down at that level, correct? So yes, so essentially the Wyckoff is it's a stepping stone. It's a stepping stone to the A10 strategies. So we'll use Wyckoff to look at the market and to tell what market cycle it is in. But after that's where it stops. So we only figure out whether it's in the accumulation of accumulation markup, markdown, or distribution level, right? But we do not use that for the trading. We only know that those are levels that we know the market maker is doing something here, right? And then something will happen, and then we'll enter the trade.
I see. Okay.
Yeah.
Okay.
So that's so Wyckoff lah.
Okay. Okay. Question from Renoi. When is Dom coming back to Singapore?
This one is not really relevant to trading, right? So I'm stuck. I'm still stuck here because of the COVID situation, right? And Chinese New Year, there's a eight-person rule, right, on the visiting. So my parents told me not to come back, and so I will be spending Chinese New Year overseas.
Yeah. Okay. One more
So
question.
maybe when the COVID situation starts to die down.
Yeah, for sure. Okay. Question is thoughts on smart money. I mean, this whole Q&A has been about smart money lah. So obviously Dom agrees to smart money, and obviously he uses the ideology of it.
Concept of smart money, yeah, and the thing is that smart money always wins, right? So I would like to talk about, okay, so this smart money thing, right? There's a really recent saga that went on Wall Street Bets, right? So it's about the GameStop one. So the GameStop mentality, the GameStop saga, right, is a very good example of why smart money always wins, right? So the retail will never win. Why? Because the retail is very disorganized and the retail does not have enough capital injection. And also because the odds are stacked against them, right? Because the smart money is working in the brokerages and the market and the liquidity providers, right? So they control the market. So it's either you join the smart money or you lose out in the long run.
Okay. Any other questions you all have? I really suggest you all to ask anything that you all really want, because it's really this might be your only chance. Yeah. So really just try to ask.
I mean, they can ask through you, and then you can ask me, right? It's the same thing.
Can also. Yeah. Okay.
Yeah. So I think that's all right. That's all we have. Let me just go through.
Okay. So yeah. Anyways, really, huge thanks to Dom for joining us for today's Q&A. I mean, personally, I definitely learned a few new things from definitely his experiences from being an institutional trader. So I really hope that everyone that watched this video, like live or later, that when it's posted on YouTube, definitely learn a thing or two. I really think it's super eye-opening. I really think it's definitely everyone should really watch this. Like I'll send it to the group again, and if you all need to watch it again, definitely do that, because really, the understanding of how everything kind of links together and the concepts of an institutional trader, or like you can say smart money, it really makes a lot more sense to me now lah. Yeah. So I think yeah, that's all. Dom, you got anything else to add for them before we end off?
Mm, nope, that's all. Thanks for the time.
Okay. Yeah, thank you so much, guys. So yeah, later the video will be uploaded onto YouTube. So see you guys.